My name is Avinash Persaud. I spent the first part of my career in the City of London. I've managed a hedge fund and today I advise investors. The Labour Party proposes to extend an existing stamp duty on share transactions. It's already collecting about £3.3 billion. It's primarily paid by pension funds and retail investors, and they want to close a loophole which allows hedge funds and banks to get away without paying this tax. Closing that loophole will bring in a further £1 billion. They're also talking about extending this tax. It's one of the cheapest taxes to collect, one of the hardest taxes to avoid. So extending it beyond shares to other instruments like bonds and also derivatives. And that will raise an additional £4.7 billion per year. When estimating the revenues that are going to be raised from a tax, you must, of course, take into account any behavioral change. All taxes create an incentive for people to avoid the tax, whether it's income tax or capital gains tax. And so the degree to which people do less of the thing that's now being taxed, a measure of that is called elasticity of demand. And we take those into account. Now, there's been a lot of empirical research done on what that ratio is. And the average it's about 1. So in the case of financial markets, so a 10% rise in the costs of transacting has a 10% drop in demand. Now, we assume a much higher elasticity, a much stronger effect, just to be conservative. We're assuming that a 10% rise in costs will actually lead to something like a 15% decline in demand or more. And so our numbers take into account the behavioral aspect and are really very conservative. We are proposing that financial intermediaries pay a lower tax rate than everybody else, a tax rate of 0.2% versus the normal tax rate, standard rate of 0.5%. And the reason why is we don't want in any way to discourage market making. Genuine market-making activity, someone who's facilitating, someone who owns shares to find the person who wants to buy them, that activity is healthy for a financial system. We certainly have to encourage that and not discourage it. And a special rate for intermediaries does that. I see the financial transaction tax as actually improving liquidity in financial markets. Indeed, I think it's now become an imperative because liquidity in our markets is beginning to be affected by this dominance of high-frequency trading. We've seen the largest markets in the world suffer from flash crashes. It's a new phenomenon. It's because the amount of high-frequency trading has grown dramatically. Many years ago, high-frequency trading, market making was about 10% of total activity. Today, it's about 70% of the daily trades. And this activity saps liquidity. When high-frequency traders see a trend in markets, they try to run ahead of the trend. They try to sell more when other people are selling. They try to buy more when other people are buying. And they try to do it quicker than them. And that reduces liquidity. This tax will cut that kind of behavior and bring long-term buyers and sellers together, improving liquidity. There'll be no relocation of trades if we impose a financial transaction tax and broadened it in the United Kingdom. One has to ask, why would they relocate? We're not taxing where they trade. We're taxing based on where people are resident and what they're trading. So if you are a US resident trading in London on non-UK instruments, you don't pay a tax today and you won't pay a tax tomorrow, so you're not going to go anywhere. But if you're a UK resident, a UK firm resident, and you move all your trades to Paris or Frankfurt, you will still pay the tax wherever you trade by virtue of the fact that you are a UK resident. And if you go anywhere around the world but you're trading UK instruments, it doesn't matter whether you trade them in Hong Kong or Johannesburg or Buenos Aires. If they're UK instruments, you pay the tax. So there's no reason, you get no benefit for relocating your trades. There'll be no relocation from the city. In addition to that, of course, Milan and Paris have now got a new tax themselves. So there'll be no incentive to go to the centres in which have a tax. And Frankfurt, Germany, is considering also having a financial transaction tax. One question is whether people will move their tax residency, and whether by moving their tax residency they would avoid paying the tax. Of course, that applies to any tax we have. You and I can move our tax residencies to avoid income tax, to avoid capital gains tax. Moving your tax residency is a big deal. When the hedge fund industry thought they would move to Switzerland, when the UK introduced a 50% tax rate, very few people move because there's a lot more to where you live than the tax rate. And we're talking about a tax rate, of course, that's 0.5%. That's not paid by companies, but investors in those companies. And so the likelihood that they will move their tax residency is much lower than the likelihood that they will move their tax residency based on corporation tax rates. And already there is an opportunity for them to do that, and they don't do it. It's very important to bear in mind, however, that increasing a tax has the same economic impact as increasing fees for a transaction. And if people are worried about the economic consequences of tiny changes in tax, then they must be deeply concerned about the size of fees, because these taxes are a fraction of total fees. So if this tax is causing an economic problem, one has to wonder, what are the fees doing? Because these fees are often twice, sometimes 3 times the taxes. So I think the concern that some in the industry have about the tax should be turned around to a concern about the fees. Some surveys have suggested that if you, at the end of your pension, the total amount of fees and charges that the average pensioner has paid in some of these pension plans can amount to 80% of all the money they've put in. This tax rate goes nowhere near that size of fees. I used to be a managing director of State Street, one of the world's largest asset managers, managing assets for pension funds primarily. And one of the things you learn from that is that pension funds turn over their portfolios very slowly, once every 3 years. That compares with, say, some hedge funds who are turning over their portfolio once every 3 weeks. So when people say that pension funds will pay the tax, they will pay the tax least because this is a churning tax. Those who churn the most will pay the most. And if there's a pension fund out there churning pensioners' portfolios several times, they will pay the tax, yes, and hopefully that will discourage them from doing that, because that churning is very bad for the interests of the pensioners. So the incidence of this tax is not about whether you're a pensioner or not, it's about how often your portfolio is churned. Pensioners churn their portfolios very infrequently. The people who will really pay this tax are those who churn a lot, like banks and hedge funds. In fact, I think that this tax rate will actually encourage better behavior for the managers of pension funds. I think this tax on churning, this tax on high-frequency trading behavior, will encourage the managers of pension funds to stop churning portfolios. And ultimately, that will be much better for pensioners. Because when they churn the portfolio, it's not just a tax that the pensioner ends up paying, it's all those fees and charges related to that churn. And if we reduce those fees and charges, the pensioner ends up better off. Critics have said that the tax isn't just the 0.2% on the intermediary, but it's a multiple of that as people trade many times over. The first thing to remember is there already are transaction costs. The critics tend to assume that all costs which are taxes are bad and all costs which are fees are somehow good. So if we have a cascading problem, we already have a cascading problem. Every trade that's done, there's a cost going through the exchange. There's a cost to clear and settle that transaction. And I think that cascading has not proved a problem at all. The additional point I would make is that if cascading was an issue, it may change the way market makers behave. It may be that market makers start acting more as brokers, where they don't actually own the share themselves, but they match buyers and sellers together. So I see little risk from the cascading effect. I think this financial transaction tax will not be bad for the City of London. And remember, there are many financial centres that have taxes, some of the fastest growing financial centres. Hong Kong has a similar tax. Mumbai has a similar tax. But I think that the key point to remember is that this tax will make our markets better. It will give our markets more integrity. There'll be less flash crashes. More sustainable, more stable markets with great integrity will actually encourage more business, more sustainable business. So at the end of the day, I think the City of London will prosper from this tax. The prospect of Brexit means it's all the more important that we make these changes to our financial markets. If we lie outside the large markets and economy of the European Union, we need to make sure that our financial markets are not seen as especially volatile, lacking of stability, not a place where long-term buyers meet long-term sellers. And this tax will make our markets stronger and more stable. I believe the FTT will be very good for the economy. What we've seen over the past 10 years is that the biggest impact on the economy has been the financial crisis. The financial crisis cost trillions of dollars. One estimate is $7 trillion. And part of the reason why we had such a large financial crash is because we had so much frenzied activity in finance beforehand. And one measure of that, one indication of that, is the amount of gross transactions that were going on when the underlying behavior, the underlying exposure, the real economic value was much tinier than the gross transactions. That difference between gross and net exposures is a measure of systemic risk that risks the economy. This financial transaction tax will reduce that. It will bring down the mismatch between finance and the real economy. It will close that gap. And so ultimately it will reduce, not eliminate, but reduce the incidence of financial crashes. And that will save the economy untold billions and perhaps even trillions. I think if we look at sustainable jobs, I think the FTT will not reduce sustainable employment. There may be some employment in some of these frenzied activities of high-frequency trading that will be lost, but we're talking about hundreds. Now, if the resources from the tax are invested in infrastructure, invested in the economy, the net impact on employment will be very positive. In estimating the revenues from this tax, something like £25 billion over the course of 5 years, we focused on the impact on markets of the costs of higher taxes, not on the enormous economic and social benefits that can come from spending £25 billion over 5 years. That money could be spent on infrastructure, on education, on health, which will have enormous economic benefits. I think the reason why the financial sector reacts so strongly to talk of a financial transaction tax is that over the years, the model of finance has changed. It's moved away from actually getting directly finance to end users, to individuals, to investors, to a model where they're making money from just doing transactions. And so they want to do more and more transactions. And the latest research shows that this has not reduced the cost of finance to the end users. The cost of raising the same amount of money has actually not gone down over the years. It's the same cost proportionally as it was 120 years ago. And so they don't like this transaction tax because it really hits at that model, and it will turn us back to an old model of where finance and banking was about getting finance to investors. And that's a model where they fear they'll make less money, so they don't like it. I think this proposal is moving more and more into the mainstream. Remember that when the IMF reported at the G20 on financial taxes in 2010, they identified over 20 large countries that already had transaction taxes that were already collecting $30 billion and more per year. We have since then, France and Italy have introduced a tax. There are a number of countries in Europe trying to introduce a tax. The biggest, fastest growing economies in the world, China and India, have introduced various types of transaction taxes. So if anything, we are being a bit left behind in a momentum that is moving globally.